Today, we are diving into the taxation of cash value and policy loans for the national portion of the life insurance exam. One of the most critical concepts you must master is the tax-deferred nature of cash value growth. While money is sitting inside a permanent life insurance policy, like whole life or universal life, it accumulates interest and earnings without being subject to current income taxes. This is a primary selling point of permanent insurance, and the exam will often ask you to identify this tax advantage status. However, the taxation rules change once you decide to access that money through withdrawals or loans. When a policy owner makes a partial withdrawal from their cash value, the Internal Revenue Service follows a specific accounting rule known as first in, first out, or FIFO. This is a major point of confusion for students, because many other financial products use last in, first out. For life insurance withdrawals, the first dollars you take out are considered to be a return of your cost basis. Your cost basis is simply the total amount of premiums you have paid into the policy. Because those premiums were paid with after-tax dollars, the first dollars withdrawn are not taxed. The exam will give you a scenario where a policy owner has paid $10,000 in premiums, and the policy now has a cash value of $15,000. If the policy owner withdraws $12,000, you need to know that the first $10,000 is tax-free and the remaining $2,000 is taxed as ordinary income. A common trap on the exam is an answer choice suggesting that these gains are taxed as capital gains. You must ignore that option because gains in an insurance policy are always taxed as ordinary income. Now let us look at policy loans because the tax treatment is completely different. Unlike a withdrawal, a policy loan is not considered a distribution of value. Instead, it is viewed as a loan from the insurer using the cash value as collateral. Because it is a debt, policy loans are generally received tax-free, even if the loan amount exceeds the cost basis of the policy. This is a favorite topic for exam writers because it seems counterintuitive. You can borrow against the growth in your policy without triggering a tax bill as long as the policy remains in force. However, there is a massive trap here involving policy lapses. If a policy lapses or is surrendered while there is an outstanding loan, and that loan amount plus any remaining cash value exceeds the total premiums paid, the difference becomes taxable as ordinary income in the year the policy terminated. To help you remember the withdrawal rule versus the loan rule, keep the phrase FIFO is for life in your mind. This reminds you that first in, first out applies to life insurance withdrawals, making the cost basis come out first. On the exam, watch out for wording that mixes up the tax treatment of dividends versus cash value. While dividends are usually a return of overpaid premium and are tax-free, any interest earned on those dividends is taxable. Similarly, always look for the word lapse when a question mentions a policy loan. If the policy stays active, the loan is tax-free, but if the policy ends, the taxman comes knocking for any gain that was used to pay off that debt. Understanding that the cost basis is your shield against taxes until you exceed it will help you navigate almost any taxation question regarding permanent life insurance on the national exam. Remember that cost basis is strictly premiums paid minus any non-taxable dividends received. If the question mentions that the owner received $500 in dividends, you must subtract that from the total premiums to find the true cost basis before calculating the taxable portion of a withdrawal. Mastering these nuances ensures you will not be fooled by the clever wording often found on the national licensing exam regarding the financial mechanics of permanent life insurance policies. Focus on the distinction between the return of principal and the growth of the contract to ensure you pick the correct answer every time.